Good day, everyone. Welcome back to Accounting 429 Financial Statement Analysis. This is Mohammed Aljaber, and in today's lecture, we're going to cover Chapter 7 of this course. Chapter 7 focuses on financial analysis techniques, and as always, I want to take a quick look at the learning outcomes for this chapter before we begin. In this chapter, we are going to describe tools and techniques used in financial analysis, including their uses and limitations. And then we're going to try to classify, calculate, and interpret activity, liquidity, solvency, profitability, and valuation ratios. Then we're going to describe relationships among ratios and evaluate a company using ratio analysis. After that, we're going to demonstrate the application of the DuPont analysis of return on equity and calculate and interpret effects of changes in its components. Then we're going to calculate and interpret ratios using inequity analysis and credit analysis. After that, we're going to explain the requirements for segment reporting and calculate and interpret segment ratios. And finally, we're going to end by with describing how ratio analysis and other techniques can be used to model and forecast earnings. So let's begin. This chapter covers 4 common financial analysis tools. The emphasis, however, for the purpose of this course is going to be on financial ratio analysis and common size analysis. But before turning to financial ratio analysis and common size analysis, let's quickly take a look at graphics and regression as tools. I assume that you're familiar with charts and graphical representations. Charts facilitate comparisons and communication. So especially if you're comparing between different categories or different groups, a chart can represent the information in a much simpler and much relative way. This slide in front of you, as you can see, was created using an Excel pie chart, and it shows the geographic composition of the 2011 operating profit margin for Colgate-Palmolive's oral company, personal and home care segment. Now, the pie chart allows the analyst to communicate about the geographical composition of the segment's operating profit. And most of the operating profit margin for Colgate-Palmolive oral, personal and home care segment comes from Latin America, as you can see, as it represents 38% of the total operating profit. This chart, on the other hand, was created using an Excel bar chart, and it shows the geographic composition of the operating profit margin for Colgate Palmolive's oral, personal, and home care segment from 2007 to 2011. The bar chart allows an analyst to communicate about the geographical composition of the segment's operating profit over time. Now, most of the operating profit margin for Colgate-Palmolive's oral, personal, and home care segment has come from Latin America in each of the past 5 years. Now, the biggest change in operating profit has also been in Latin America, from around 1 billion in 2007 to more than 1.4 billion in 2011. What are the other ways to communicate these data graphically? There's no single answer, no single correct answer to this. And the other possibilities may include a series of pie charts, a series of stacked bars, etc. Now, in 2011, Colgate acquired Cenex, which is a skincare company with 2011 sales of 140 million, primarily in Western Europe. So from Unilever, and in connection with the Cenex acquisition, sold its laundry detergent business in Colombia to Unilever. So there was an exchange that occurred in 2011 between those two companies. So you might want to take that into consideration. This slide was also created using an Excel bar chart, and it shows the quarterly operating profit margin for Colgate-Palmolive. Now, in this one, it combines ratio analysis with graphics. The ratio analysis being the operating profit margin, which is calculated as operating profit divided by sales, just like we've learned previously in the income statement chapter. Now, the chart facilitates comparisons across time, and the analyst can use such a chart to communicate the relative stability or the what we call volatility of some aspect of a company's performance over time. Now, you notice the dip in the first quarter of 2010. This resulted from a one-time charge related to the transition to hyperinflationary accounting in Venezuela. You probably have studied regressions in your statistics course beforehand, and you probably know that regressions goal is to quantify statistical relationships between uh, two or more inputs or factors. Now, this slide was created using Excel. It shows the relationship between sales growth and GDP growth. The company is a cyclical company, so in this case, the analyst might use regression analysis combined with a forecast for GDP growth as one input to forecast sales growth and earnings for that company. The data used to create this chart include the years 1954 all the way to 2011. The nominal US GDP growth from the US Department of Commerce Bureau of Economic Analysis. So that was the source of the GDP um, growth figures. And the total revenue for Ford Motor Company was retrieved from CompuStat. You might also remember from our coverage of chapter 4 and 5 when we talked about common size analysis. Now, common size analysis express financial data, including entire financial statements in relation to a single financial statement item or base. And we have two types of we have vertical common size analysis is in relation to a single financial statement item. So for a balance sheet, divide each item on the balance sheet by the same period's total assets and express the results as percentages. For income statement, if you guys remember, we divided each item on the income statement by total net revenues and expressed the results as percentages. This analysis highlights composition and helps identify what items are more important. And now the other type is the horizontal common size analysis and is in relation to same item in prior periods. So calculates a percentage increase or decrease of each line item from the prior year. And alternative presentation is to calculate each item relative to its value in a base year. This analysis highlights items that have changed unexpectedly or have unexpectedly remained unchanged. A common size balance sheet shows only the percentage of total assets represented by each line item. So the judgment of the analyst and his interpretation is going to be required in that case to answer some questions. For example, what are the important components of the company's balance sheet? Have any notable changes occurred? What caused these changes to occur? So if we look at the example we have in front of us here on the slide, we are going to see uh, what are the merits that deserve to be commented on in this specific example. Here you notice in period 2, receivables are 57% of total assets. And in that case, once we notice that, now we want to look at everything about receivables, including allowance for depreciation, amortization. What are possible reasons for the increase in the receivables? So the company is making more of its sales on credit basis rather than a cash basis, perhaps in response to some action taken by a competitor. Alternatively, the increase in receivables as a percentage of assets may have occurred because of a change in another asset category. For example, a decrease in the level of inventory. The analyst would then need to investigate why that asset category had changed. Another possible reason for the increase in receivables as a percentage of assets is that the company has lowered its credit standards, relaxed its collection procedures, they call it, or adopted more aggressive revenue recognition policies. So the analyst can turn to other comparisons and ratios, for example, comparing the rate of growth in accounts receivable with the rate of growth in sales, to help him determine which explanation is most likely to um, explain what that increase in the receivables as a percentage of total assets. Here is another example of a common size balance sheet. This time we're using a vertical common size analysis where we are comparing two different companies. Now here we're going to ask ourselves some questions such as what merits commentary in this comparison, what are the important components of each company's balance sheet, what are the notable differences between the two, and what explains those differences. So as you can see here, we have the balance sheet for two hypothetical companies at the same point in time. Company one is clearly more liquid, liquidity being a function of how quickly assets can be converted into cash. Um, and then company two, as you can see, has only 12% of assets available as cash compared with the much more liquid company one, where they have 38% of their total assets in cash. And given that cash is generally a relatively low yielding asset and thus not a particularly efficient use of excess funds, why does company one hold such a large percentage of total assets in cash? This kind of question uh, the analyst must ask himself. Perhaps the company is preparing for an acquisition or maintains a large cash position as insulation from a particularly volatile operating environment such as COVID these days, for example. Companies might um, find it uh, um, much more uh, realistic to try to protect themselves and have a lot more or a higher percentage of their total assets in cash. Another issue highlighted by the comparison in this example is the relatively high percentage of receivables in Company two's assets, which may indicate a greater proportion of credit sales overall changes in asset composition, lower credits or collection standards, or even uh, more aggressive accounting policies. Here we have an example to look at how we could use uh, comparative growth information. This example looks at Sunbeam, which is a US company. Uh, in July 1996, they brought in new management to turn the company around. So the company was having some issues, and they decided to change the management to try and improve their position. In the following year, 1997, using 1996 as the base, the following was observed based on reported numbers. The revenue have increased 19%, receivables increased by 38%, and inventory increased by 58%. It is generally more desirable to observe inventory and receivables growing at a slower or similar rate compared with revenue growth. Receivables growing so much faster than revenue could indicate operational issues such as lower credit standards. So the company is granting credit to people with low credit ratings or having credit issues. The other thing that could be aggressive accounting policies for revenue recognition. Similarly, inventory growing faster than revenue can indicate an operational problem with obsolescence or aggressive accounting policies such as an improper overstatement of inventory to increase profits. An alternative innocence explanation could have been that the company was building inventory in anticipation of demand. In the case of Sunbeam, the explanation lay in aggressive accounting policies. Sunbeam was later charged by the U.S. Securities and Exchange Commission, the SEC, with improperly accelerating the recognition of revenue and engaging in other practices such as billing customers for inventory prior to shipment. Now let us move on to the fourth analysis tools that we're using, which is the ratio analysis. Ratios basically express one number in relation to another. So they standardize financial data in terms of mathematical relationships expressed as percentages, times, or days. And the ratios can facilitate comparisons, trends, and cross-sectional comparisons. Ratios are interrelated. For example, an inefficient firm with low asset turnover and low receivables turnover and low inventory turnover is likely to have poor profitability, low return on sales and low return on assets, or low return on equity, leading to low market valuation, low price earnings ratio, for example, leading to difficulty in selling equity, leading to high leverage, high debt to equity, etc., leading to high cost and risky funding, high funding costs in terms of a higher interest expense and stricter credit policies from trade creditors, and finally leading to poor profitability and so on. So you see how all these different ratios can link to each other, and each ratio probably would cast a shadow on the other set of ratios that are usually used in financial analysis. So it's all interrelated and connected in some way. Now, this is an issue that I face with many students over the previous semesters. Some students fail to understand that the number of the ratio is not the answer that we are looking for. So, if you get a question, how profitable was company X, for example, your answer cannot be 15.26%, for instance, because the ratio is not the answer that we're looking for. The ratios merely provide you with an indicator, and you as an analyst need to give a meaning to that ratio. You need to give an interpretation to that ratio, and what it means in the broader sense. So knowing that the ratio is just an indicator, um, we are looking here at the profitability of company X. We can see that the net profit margin is just indicating the profitability. And in order to interpret that number and evaluate the company's position, we generally need to compare it to something. So here the comparison is between company X's profitability this year versus last year. Furthermore, it is generally not enough to state the interpretation or the evaluation. The analysis needs to address the question of why. So profitability changes because of changes in revenue, which in turn are driven by changes in volume, price, or exchange rates, and are related to a company's business activities, products, markets, and or the changes in expenses with the change in specific categories of expenses related to a company's business activities. So you always need to look beyond the number, compare it to something else, give an interpretation, and also try to find the reason or the causes for the change in that specific ratio or number. You could also interpret and evaluate the company relative to another company, a competing company. So in this case, the comparison is between company X's profitability and company Y's profitability. Uh, as you can see, uh, it's not enough um, to state the interpretation. You need to also try to analyze and address um, the reasons behind it. So, in here, when comparing between two companies, you need to also try to find out what are the reasons that company X was more profitable than company Y. So, in summary, um, Whether you're using ratio analysis or any other tools of financial analysis, you need to understand that computation does not equal analysis. So the effective analysis encompasses both computations and interpretations, and a well-reasoned analysis differs from a mere compilation of various pieces of information by integrating the data collected into a cohesive whole. Analysis of past performance, for example, should address not only what happened, but also why it happened and whether it advanced the company's strategy. Some of the key questions to address include what aspects of performance are critical for this company to successfully compete in this industry or this sector. How well did the company's performance meet these critical aspects? Established through computation and comparison with appropriate benchmarks, such as the company's own historical performance or competitors' performance. And finally, what were the key causes of this performance, and how does this performance reflect the company's strategy? You also need to understand that not every ratio is relevant in every situation. Some ratios are irrelevant for certain companies. For example, inventory turnover and days of inventory on hand are irrelevant to a company with no inventory. For example, financial services firms or internet firms like Facebook um, or Snapchat or so on. Some ratios are redundant. Inventory turnover and days of inventory on hand tell you exactly the same thing. So the two ratios are mechanically related. So if firm A has higher inventory turnover than firm B, it follows as a mathematical fact that firm A will have lower days of inventory on hand than firm B. So you do not need to present or discuss both ratios in this case. Industry specific ratios can be as important as general financial ratios. For example, the hotel industry tracks occupancy, which represents rooms sold divided by rooms available, and average daily rate, which is the total room revenue divided by number of rooms sold, um, and RevPAR, or revenue per available room, which represents total room revenue divided by number of rooms available. So you should always understand that different users and questions will focus on different ratios. Creditors, for example, will have a particular focus on solvency ratios, leverage, and coverage, while investors would focus on market ratios, PE, price to earnings, or price to book ratios, combined with financial ratios. Different sources categorize some ratios differently and include different ratios. Sources include textbooks and commercially available databases like the Thomson Reuters Value Line, Yahoo, Morningstar, Zacks Investment Research. For some ratios, there is little difference. The current ratio is probably universally defined as current assets divided by current liabilities and viewed as an indicator of liquidity. And for other ratios, differences in categorization, um, such as cash conversion cycle, days of inventory on hand plus days of sales outstanding minus days payable. The cash conversion is categorized as a measure of liquidity but is clearly closely related to a measure categorized as measures of efficiency. Now, different sources include different ratios, and different accounting standards can result in different reported financials, which in turn can limit the comparability of ratios. So care should be taken with different accounting standards when you're analyzing companies that follow different accounting standards. On this slide, you see the five main categories of financial ratios. We have activity, liquidity, solvency, profitability, and valuation. Now, activity ratios, these try to gauge how efficient are the firm's operations and the firm's management uh, of their assets. And liquidity ratios, they try to assess how well is the firm positioned to meet short-term obligations, where the solvency ratios try to gauge how well is the firm positioned to meet long-term obligations. The profitability ratios try to figure out how and how much is the firm achieving returns on its investments. And finally, the valuation ratios, which try to assess how does the firm's performance or financial position relate to its market value. Here we're going to begin with the profitability ratios and try to understand it a little bit more. One of the most important measures of profitability is the return on equity. Now, the way we derive the return on equity ratio is from the basic rate of return formula, which is simply the amount of return divided by the amount invested. So if you take the amount you ended up with in a specific project or investment and you subtract the amount you started with at the beginning, you're going to get the difference or the amount of return. You divide that by the amount you originally invested in the project and you're going to get the rate of return. Now for the return on equity, we're going to take the net income, which if you remember from our chapter 4 study was the total revenues minus total expenses, and we divide that by the average equity over that specific period of time. After we have learned the return on equity ratio and how we derived it, now we're going to decompose the return on equity or ROE. We're going to decompose it into its component parts, and the reason we do this and why doing this is so useful because it serves so many purposes. It's going to help us understand what drives a company's return on equity. It's going to help us determine the reasons for changes in return on equity over time for a given company. It helps us determine the reasons for differences in return on equity for different companies, and for suggesting areas to focus on to improve the return on equity for a specific company, for showing why a company's overall profitability measured by ROE is a function of its efficiency, operating profitability, taxes, and use of financial leverage. Um, and finally, for examining the relationship between the various categories of ratios discussed in this chapter and how they all influence the return on the investment of the owners. Now, decomposition of return on equity is sometimes referred to as the DuPont analysis because it was originally developed at that company. Decomposing ROE involves expressing the basic ratio, uh, i.e., the net income divided by average shareholders' equity, as the product of component ratios. Now, each of these component ratios is an indicator of a distinct aspect of a company's performance that affects ROE. So the decomposition allows us to evaluate how these different aspects of performance affects the company's profitability as measured by its ROE. Expressing ROE as a product of only two of its components, we can write that ROE equals net income divided by average assets multiplied by average assets divided by average equity. So we basically multiplied the original formula by 1, that 1 being the average assets divided by itself. And this is how we expanded the equation. For purposes of analyzing ROE, this method usually uses average balance sheet factors. However, the math will work out if beginning or ending balances are used throughout. Now, the two components can be interpreted as return on assets and leverage because it expresses how many dollars of assets are supported by each dollar of equity. In other words, return on equity is a function of a company's return on assets, which is the net income divided by average assets, and its use of financial leverage, which is represented here by the average assets divided by average equity. Now, knowing the new form we created for the ROE formula, we can conclude that a company can improve its return on equity by improving their return on assets or by making more effective use of leverage. Consistent with the definition given earlier, leverage is measured as average total assets divided by average shareholders' equity. So if a company had no leverage, no liabilities, in other words, its leverage ratio would equal 1, and return on equity would exactly equal return on assets. As a company takes on liabilities, its leverage increases. And as long as the company is able to borrow at a rate lower than the marginal rate, it can earn investing the borrowed money in its business. So the company is making an effective use of leverage, and return on equity would increase as leverage increases. If a company's borrowing cost exceeds the marginal rate, it can earn on investing in the business. Return on equity would decline as leverage increases, because the effect of borrowing would be to depress return on assets. Here, let us take a closer look at return on assets, or ROA. Uh, Return on assets measures the return earned by a company on its assets. So it basically tries to answer the question, what rate of return has the firm earned on the assets it had available to use during the year? The higher the ratio, the more income is generated by a given level of assets. And most databases compute this ratio as net income divided by average assets, which we looked at previously in the equation we covered. An alternative method to calculate that is to use net income adjusted for interest as the numerator. And this form of the ratio reflects that net income plus after-tax interest is the amount of earnings applicable to both equity holders and creditors, consistent with assets being financed by both um, the equity holders and creditors. Net income after the deduction of interest is the return solely to equity holders. In general, whichever form of ROA is chosen, the analyst must use it consistently with in their comparison with other companies or over specific time periods. For simplicity, the DuPont analysis will use the first variant we covered, which is the net income divided by average assets. And by analyzing the equation, we can see that a company can increase its return on assets in two basic ways. By increasing operating profitability, or what we call operating profit margin, or by increasing asset turnover, that is, better asset utilization or efficiency. In other words, return on assets can be thought of as profit margin multiplied by turnover. And by combining the decomposition of return on assets with the previous step, we have three basic factors underlying profitability. First term on the right-hand side of this equation, which is profit margin, an indicator of profitability, and it shows how many dollars of income the company can generate for each dollar of revenue. Second term on the right, turnover, uh, which is the asset turnover ratio. This one indicates efficiency, and it shows how many dollars of revenue the company can generate for each dollar of its assets. Third term on the right hand, which is leverage, is an indicator of solvency, and it shows how many dollars of assets are supported by each dollar of equity. Note that return on assets is decomposed into the first two of these components, net profit margin and the total asset turnover, and a company's return on assets is a function of profitability, the net profit margin, and efficiency, the total asset turnover. This decomposition illustrates that a company's return on equity is a function of its net profit margin, its efficiency, and its leverage. So there's three factors that play a role here. Further decomposition can be used to examine the effects of tax and the costs of financing. First, we will look at an example using the three-way decomposition, and then we can take it from there. Before we move on to the example, we also need to understand the purpose we are doing this. Why are we decomposing return on equity? The reason being is that decomposing return on equity can help us determine what is the main drivers of the return on equity for a specific company. So, to what extent was it derived from selling a high margin product or keeping expenses low? Was it derived from generating higher sales from a lower investment in assets, or was it derived from investing a lower amount of equity by using more debt in its capital structure? Here we have a mini case example to try and analyze using the decomposition or by decomposing the return on equity. As you can see here in front of you, we have three companies, um, hypothetical companies, company A, company B, and company C. And as you can see, all three companies have the same exact return on equity. Now, what we need to do is to try to decide to what extent was it derived from selling the return on equity of a company was derived from selling a high margin product or keeping expenses low, deriving more profit from each $1 of sales, or was it derived from generating higher sales from a lower investment in assets? Or was it derived from investing a lower amount of equity by using more debt in its capital structure? So these are the three cases we discussed earlier. So was the return on equity derived by net profit margin, or by turnover, or you can call it efficiency, or by leverage, right? So let's look here. The three companies, as I mentioned, have the same exact return on equity. If you look at the return on equity line, you can see that the return on equity for each of the three companies is 20%. Now, decomposing the return on equity components, we can see that the company A return on equity is driven by its net profit margin, having the highest net profit margin, 10% versus uh, the average of 4.7% for the three companies combined. For company B's return on equity, as you can see, is driven by its leverage. So they have a 2x leverage versus the 1.5 average for the three companies. Um, its turnover is below average and its profit margin is very slightly above average, but leverage is what's driving their return on equity. And for company C's return on equity is driven by its turnover. As you can see, their turnover is 4.45 versus the average of 2.82 for the three companies. So as you can see how decomposing return on equity can help you as an analyst to dig dig deeper in the data and try to understand the company you're analyzing a little bit more. This slide presents the return on equity decomposition for three actual companies using 2008 data for three companies being Apple, Hewlett Packard, which is HP, and Dell Company. So all three tech companies. What was the source of each firm's return on equity? As you can see from the data represented in front of you, for Dell, significantly higher financial leverage and asset turnover compensated for low net profit margin. For Apple, the net profit margin is much higher, reflects a strategy of competing on product features rather than price. You probably know this about Apple. And asset turnover is lower and reflects a strategy of having own retail stores, also not shown on the slide. Apple's lower turnover reflects its retail strategy, which requires increased investment in PPE, the significant amount of cash on its balance sheet, which generates non operating income, does not generate revenue, and subscription accounting for iPhones, creating deferred tax assets, which also um, reflects in Apple's numbers. We mentioned earlier that we can decompose return on equity a little bit further to account for taxes. So to separate the effects of taxes and interest, we can further decompose the net profit margin um, as follows. Net income divided by average equity is going to equal net income divided by earnings before tax multiplied by earnings before tax divided by earnings before interest and tax multiplied by earnings before interest and tax divided by revenue. For return on equity overall, net income divided by average equity is going to equal net income divided by EBT, which is earnings before tax, multiplied by EBT divided by EBIT or EBIT, multiplied by EBIT divided by revenue, multiplied by revenue divided by average assets, and multiplied by average assets divided by average equity. This can be interpreted as return on equity equals tax burden multiplied by interest burden multiplied by EBIT margin multiplied by total asset turnover multiplied by leverage. Now the tax burden, which is net income divided by EBIT or earnings before tax, measures the effect of taxes on return on equity. Essentially, it reflects the percentage of pre-tax profits the company keeps as net income after deducting the tax expense. It is equivalent to 1 minus the average tax rate. For example, a 30% tax rate would yield a factor of 0.7 or 70%, which is 1 minus 0.3. And a higher value for the tax burden implies that the company can keep a higher percentage of its pre-tax profits, indicating a lower tax rate. A lower value for the tax burden ratio implies the opposite, so a higher tax rate, leaving the company with less of its pre-tax profits. The interest burden, or EBT divided by EBIT, captures the effect of interest on return on equity. Essentially, it reflects the percentage of pre-interest and tax profits the company keeps as pre-tax profits after deducting the interest expense. Lower borrowing costs increase return on equity, and higher borrowing costs reduce return on equity. Some analysts prefer to use operating income instead of EBIT for the second and third terms in this equation, and in such case, the second term would capture both the effect of interest expense and non-operating income on return on equity. Earnings before interest and tax margin, or the EBIT, EBIT divided by revenue or operating margin. If operating income is used in the numerator, would capture the effect of EBIT margin or operating margin if operating income is used on return on equity. In either case, this term primarily measures the effect of operating profitability on return on equity. Now, the total asset turnover ratio, which is the revenue divided by average assets, is an indicator of the overall efficiency of the company, i.e., how much revenue it generates per unit of total sales, per unit of total assets, that is. Financial leverage ratio, which is, as you remember, average assets divided by average equity, shows the total amount of a company's assets relative to its equity capital. This decomposition expresses a company's return on equity as a function of its tax rate, interest burden, operating profitability, efficiency, and leverage. So it combines all those 5 factors together. An analyst can use this framework to determine what factors are driving a company's return on equity, and the decomposition of return on equity can also be useful in forecasting return on equity based upon expected efficiency, profitability, financing activities, and tax rate changes in the future. Now, before we move on to the other categories of ratios, here on this slide, you can see a revision of several common profitability ratios that can be taken directly from the common size income statement. Remember when we done chapter 4 in the practical session, I showed you how we can create a common size income statement, and I showed you how some ratios are directly taken from the statement itself. If you remember, the gross profit margin, for example, which equals the gross profit divided by revenue, and the operating profit margin, which equals the operating profit divided by revenue, and finally the net profit margin, which equals net profit divided by revenue. Since in the common size income statement we measure all these items in relation to the revenue, so we divide the gross profit by revenue, for example, to calculate the percentage for that number. That is why this operation directly give us the ratio calculation right away from the common size income statements. Now that we have covered the decomposition of return on equity, we can turn to the other various categories of ratios. We're going to begin with the activity ratios and liquidity ratios, which are closely related. Here we're going to begin with the activity ratios. These are also known as asset utilization or operating efficiency ratios, and they're designed to measure how efficiently is the firm using its assets, how many dollars of sales was the firm able to generate from each dollar of assets. Broadly, asset turnover equals revenue divided by average total assets. Now, a low or declining ratios could mean that sales are sluggish and slow, maybe heavy investment in assets, inefficient plant modernization, which will help in future strategy shifts, and it could mean asset mix changed. Specifically for fixed assets turnover equals revenue divided by average net fixed assets. So it can be computed for any category of assets. And here I'm going to introduce you to three activity ratios. First one is working capital turnover, and this one is calculated by dividing the revenue by the average working capital. The second one is the fixed asset turnover, which is revenue divided by average net fixed assets. And the third one, and last one, is the total asset turnover, which is revenue divided by average total assets. Here you're presented with some other common activity ratios. We're not going to worry too much about them, but it's worth um, uh, taking a general look and trying to understand what they stand for and what they gauge. We have inventory turnover, which is the cost of sales divided by average inventory. We have days of inventory on hand, DOH, which is the number of days in period divided by the inventory turnover. We also have receivables turnover, which is the revenue divided by average receivables. We also have days of sales outstanding, DSO, a number of days in a period divided by receivables turnover. Payables turnover, which is purchases divided by average trade payables. And finally, a number of days of payables, which is the number of days in a period divided by payables turnover. Remember how I mentioned earlier that activity ratios are closely linked to liquidity ratios? Here we'll look at what is called the cash cycle or the cash conversion cycle, which is a liquidity ratio. Now the cash cycle measures how long does it take for the firm to go from cash to cash. So for a service company, they sell the service and receive the cash. For a merchandising company, they first spend the money by buying inventory, sell the inventory, receive cash, and then pay for other inventory, right? For a manufacturing company, they buy raw materials, they process or manufacture the product or make the product, and then sell the product and receive the cash, pay for some more materials and labor, right? How do we calculate the cash conversion cycle or the net operating cycle? It's calculated by the days sales outstanding plus days inventory held minus number of days of payables. Now let's move on to liquidity. Liquidity refers to a company's ability to meet its short-term financial obligations. The level of liquidity needed differs from one industry to another, so from one sector to another. A particular company's liquidity position may vary according to the anticipated need for funds at any given time. So, judging whether a company has adequate liquidity requires analysis of its historical funding requirements, current liquidity position, anticipated future funding needs, and options for reducing funding needs or attracting additional funds, including actual and potential sources of such funding. Liquidity ratios reflect a company's position at a point in time and therefore typically use data from the ending balance sheet rather than averages. So the current, quick, and cash ratios reflect three measures of a company's ability to pay current liabilities. Each uses a progressively stricter definition of liquid assets, and we're going to see how each of those is calculated shortly. Beginning with the current ratio, which is calculated by current assets divided by current liabilities. And then we have the quick ratio, which is cash plus any short-term marketable securities or investments plus accounts receivable divided by current liabilities. And finally, the cash ratio, which only considers cash and short-term marketable securities divided by current liabilities. Moving on to solvency ratios. Now, for solvency category, it carries ratios that tries to measure how well positioned is the firm to meet its long-term liabilities. Generally, two types of solvency ratios are debt and coverage. Debt is how much debt does a company have in its capital structure. Coverage uh, by how much did earnings cover the interest costs. Now, for debt ratios, we have debt to assets, debt to equity, and debt to total capital. Okay, and the lower the ratio, the safer the company is financially, or the better positioned the company is to meet its long-term liabilities, and the higher cushion against potential creditor losses. Now, for coverage ratios, we have um, EBIT interest coverage, which is calculated by EBT, or earnings before tax, plus interest payments divided by interest payments. And we have fixed charge coverage, which is earnings before interest and tax plus lease payments divided by interest payments plus lease payments. Here we have a list of some of the most commonly used solvency ratios. We begin with the debt to assets ratio. Of course, you can see how these are all calculated in front of you on the slide. Instead, I'm going to focus on what they mean and how we can interpret them. So beginning with the debt to assets ratio, this one measures the percentage of total assets financed with debt. For example, a debt to asset ratio of 40% indicates that 40% of the company's assets are financed with debt. Generally, higher debt means higher financial risk and thus weaker solvency. Next one is the debt to capital ratio. This one measures the percentage of a company's capital, which is debt plus equity, represented by debt. As with the previous ratio, a higher ratio generally means higher financial risk and thus indicates weaker solvency. After that, we have debt to equity ratio. This one measures the amount of debt capital relative to equity capital, and we can interpret this in similar to the preceding two ratios. The higher ratio indicates weaker solvency. A ratio of 1 would indicate equal amounts of debt and equity, which is equivalent to a debt to capital ratio of 50%. Alternative definitions of this ratio use the market value of stockholders' equity rather than its book value, or use the market values of both stockholders' equity and debt. Next, we have financial leverage ratio. This one is often called simply the leverage ratio. This one measures the amount of total assets supported for each one money unit of equity. For example, a value of 3 for this ratio means that each $1 of equity supports $3 of total assets. The higher the financial leverage ratio, the more leveraged the company is in the sense of using debt and other liabilities to finance assets. This ratio is often defined in terms of average total assets and average total equity and plays an important role in the DuPont decomposition of return on equity discussed before. Uh, After that, we have interest coverage. And this one measures the number of times a company's EBIT could cover its interest payments. Thus, it is sometimes referred to as times interest earned. A higher interest coverage ratio indicates stronger solvency, offering greater assurance that the company can service its debt, i.e., bank debt, bonds, and notes, and so on. The last one is the fixed charge coverage. This one relates fixed charges or obligations to the cash flow generated by the company. It measures the number of times a company's earnings before interest, taxes, and lease payments can cover the company's interest and lease payments. Similar to the interest coverage ratio, a higher fixed charge coverage ratio implies stronger solvency, offering greater assurance that the company can service its debt. Um, the ratio is sometimes used as an indication of the quality of the preferred dividend, with a higher ratio indicating a more secure preferred dividend. And for the final ratio category we're going to look into is valuation category. The valuation ratios basically try to assess how does the firm's performance or financial position relate to its market value. And of course, we have to begin the valuation ratios with the price to earnings ratio, or the PE ratio. Probably the most widely cited indicator in discussing the value of equity securities, and it basically relates the share price to the earnings per share, or the EPS. بالعربي يسمونه مكرر ربحية، يمكن كثير تسمع المصطلح هذا. Now, the PE expresses the relationship between the price per share and the amount of earnings attributable to a single share, i.e., how much an investor in common stock pays per dollar of earnings. In general, a high PE indicates that the market places a high value on the earnings of that company. So, higher PE stocks are sometimes referred to as glamour or growth stocks, and lower PE stocks as usually referred to as value stocks, if you ever heard about value investing. A higher PE may reflect expectations for higher growth. So usually it links with the growth potential of that specific company. If the company has greater potential to grow in the future, the investors would normally be willing to pay more, or to pay a higher price for each dollar of earnings of that company, because they expect that company to grow in the future and achieve higher earnings. Now, interpreting the or note that sometimes a firm may have a high PE because it has very low earnings per share. This have happened during the past year, 2020. If you've noticed, if you keep up with the news, you're going to see that many companies have had increased PE ratios, not because the prices have increased that much, but mainly because earnings have dropped because of COVID. Now, interpreting the EPS is simply the amount of earnings attributable to each share of common stock. In isolation, EPS does not provide adequate information for comparison of one company with another. For example, assume two companies, A and B, have the following characteristics. Both have only common stock outstanding and no dilutive securities outstanding. Both have identical net income of 10 million and identical book equity of 100 million. Thus, both have identical profitability. So, return on equity equals 10%, using ending equity in this case for simplicity. If company A has 100 million weighted average common shares outstanding and company B has 10 million weighted average common shares outstanding, company A will report EPS of 10 cents per share and company B will report EPS of $1 per share. Now, the difference in EPS does not reflect a difference in profitability. The companies have identical profits and profitability. The difference reflects only a different number of common shares outstanding. The PE and the other price-based ratios are used in equity analysis. So price-based ratios may effectively be used by equity investors in combination with financial ratios. For example, how can an equity investor looking at a low PE stock, i.e. a value stock, figure out which of the following is more likely? Is the low PE stock undervalued? Or alternatively, is the low PE stock appropriately valued given its financial performance? Notice that since PE ratios are calculated using net income as the denominator, which is where we derive the earnings per share from, it can be sensitive to non-recurring earnings or one-time earnings events, and net income is generally considered to be more susceptible to manipulation than our cash flows. So hence the need for price to cash flow or PCF. Analysts may use price to cash flow as an alternative measure to EPS, particularly in situations where earnings quality might be an issue. We also have PS or price to sales, and it's also calculated in a similar manner. We divide the price per share by the sales per share. Sometimes used as a comparative price metric, particularly when a company does not have positive net income, so when they have a net loss. And also note that although price to sales is common, there is a theoretical mismatch in the numerator and denominator. The numerator price refers to the price of a share of common stock. However, sales relate to all providers of capital, not just common stockholders. Therefore, enterprise value to sales is considered a more theoretically correct metric. And finally, we have price to book value. This is this ratio of a price per share to book value per share. And now, this ratio is often interpreted as an indicator of market judgment about the relationship between a company's required rate of return and its actual rate of return. Assuming that book values reflects the fair values of the assets, a price to book ratio of 1 can be interpreted as an indicator that the company's future returns are expected to be exactly equal to the returns required by the market. A ratio greater than 1 would indicate that the future profitability of the company is expected to exceed the required rate of return, and values of this ratio less than 1 indicate that the company is not expected to earn excess returns. And, or you could interpret it as the company being undervalued. Here we have two more valuation ratios that relate specifically to dividends. We have the dividend payout ratio and the dividend yield. The dividend payout ratio represents the percentage of earnings that the company pays out as dividends to the shareholders. And it's calculated by dividends per share divided by earnings per share. So you can see how much of the company's earnings are actually returned back to the investors. That reflects a company's dividend policy. Optimal dividend policy is a function of many factors, but in general, a company balances current dividend payout with future growth. The amount of dividends per share tends to be relatively fixed because any reduction in dividends has been shown to result in a disproportionately large reduction in share price. So investors usually react or overreact to changes in the dividend policy. And finally, because dividend amounts are relatively fixed, the dividend payout ratio tends to fluctuate with earnings. Therefore, conclusions about a company's dividend payout policies should be based on examination of payout over a number of periods. And then we have dividend yield, which is calculated by dividends per share divided by price, and it represents the percentage or the dividends as the percentage of the share price. We also have another dividend related quantity shown in the text in your textbook, uh, and this is the retention rate, which is simply the complement of the dividend payout ratio. So if you calculate the dividend payout ratio for a specific company and then subtract it from 1, you're going to get the retention rate. Whereas the payout ratio measures the percentage of earnings that the company pays out to the investors as dividends. The retention rate, of course, is the percentage of earnings that a company retains or keeps for funding future projects. On this slide and the next slide, you have a list of selected credit ratios used by Standard & Poor's S&P as part of credit analysis of industrial companies. The source of this information is Standard & Poor's Corporate Ratings Criteria 2008. Note that before calculating ratios, rating agencies make certain adjustments to reported financials, such as adjusting debt to include off balance sheet debt in a company's total debt. Now, FFO is funds from operations defined as net income adjusted for non cash items. CFO is cash flow from operations. Ratios are only one part of credit analysis, so this links back to what we've covered before, is as that ratios are just computations, and we need to always dig deeper behind the numbers and try to figure out the reasons for these numbers and interpret them. Credit analysis is the evaluation of credit risk, which can be defined as the risk of loss caused by a counterparty's or debtor's failure to make a promised payment. Approaches to credit analysis vary, and as with all financial analysis, it depends on the purpose of the analysis and the context in which it is done. For example, credit analysis for acquisition financing and other highly leveraged financing often involves projections of period by period cash flows, similar to projections made by equity analysts. Whereas the equity analyst may discount projected cash flows to determine the value of the company's equity. A credit analyst would use the projected cash flows to assess the likelihood of a company um, complying with its financial covenants in each period and paying interest and principal as due. For credit analysis, assessing overall credit worthiness as opposed to risk of a specific transaction, one general approach is credit scoring, a statistical analysis of the determinants of credit default. The credit rating process used by credit rating agencies such as S&P to assess and communicate the probability of default by an issuer on its debt obligations. Uh, Now, commercial paper, notes, and bonds involves both the analysis of a company's financial reports as well as broad assessment of a company's operations. Meeting with management to discuss, for example, industry outlook, overview of major business segments, financial policies and goals, distinctive accounting practices, capital spending plans, and financial contingency plans. Tours of major facilities, ratings committee votes on analysts' recommendations after considering factors that include business risk, operating environments, cyclicality, and capital intensity of the industry, success factors and areas of vulnerability, company's competitive position, including size and diversification and financial risk, including the evaluation of capital structure, interest coverage, and profitability using ratio analysis. It could also include the examination of debt covenants and the evaluation of the management team itself. Now, in assessing credit ratings, rating agencies emphasize the importance of the relationship between a company's business risk profile and its financial risk. The company's business risk profile determines the level of financial risk appropriate for any rating category. In other words, a company with lower business risk has the ability to take on more financial risk. The first ratios listed are variations of coverage ratios. The other ratios measure the percentage of debt that could be paid with 1 year of FFO, then cash flow after paying for capital expenditures, then cash flow after paying for both capex and dividends. Here we have a list of additional credit ratios used by S&P as part of credit analysis of industrial companies. Notice that we have the return on capital, which is calculated by EBIT over the average capital, where the capital is equity plus non-current deferred taxes plus debt. We have net cash flow to capital expenditures, which is calculated by FFO minus dividends divided by capital expenditures. We have debt to EBITDA, which is the total debt divided by EBITDA. And then finally, we have total debt to total debt plus equity, which is obviously the total debt divided by total debt plus equity. Notice that FFO is funds from operations, as we mentioned previously, so defined as net income adjusted for non-cash items, and the CFO is cash flow from operations. And finally, we're going to end our lesson with talking about analysis model building. Analysts often need to forecast future financial performance. For example, analysts' earnings per share forecasts are widely followed by Wall Street. And the analysts use data about the economy, industry, and company to arrive at a company's forecast. The results of an analyst's financial analysis, including common size and ratio analysis, are integral to this process, along with the judgment, of course, of the analyst. And now, based on forecasts of growth and expected relationships among the financial statement data, the analyst can build a model, sometimes referred to as an earnings model, to forecast future performance. Of course, a forecast should not just be a mechanical exercise of extrapolating from historical performance and historical ratios. However, information gained from ratio analysis from prior years can provide useful input to the model. Often a forecast begins with a revenue forecast. The revenue forecast would generally be based on numerous factors, but one input to sales forecast can be percent change from prior year, as shown on the horizontal common size income statement. Then, to forecast income, an analyst can use ratios expressing the relationship between revenue and various items on the income statement. Um, an analyst may use historical common size data as an input to developing expectations about specific expense line items. The gross profit margin could be used to forecast gross profit directly or to forecast cost of goods sold. And the operating profit margin could be used to forecast operating profits directly. Now, as you will see illustrated on the following slide, forecasts typically involve iterations because the amount of borrowing is a function of cash flow requirements, which are a function of earnings and taxes, which depend on income net of interest expense, and interest expense is a function of the amount of borrowing. So forecasts of the balance sheet and cash flow statements can be derived from expected ratio data. To forecast the amount of receivables, an analyst can use the days receivable data from prior periods ratio analysis. To forecast the amount of inventory, an analyst can use the days inventory data from the prior periods ratio analysis. And to forecast the amount of property, plant, and equipment, PP&E, an analyst can use PP&E turnover data from prior periods ratio analysis. And the amount of forecast liabilities, would typically be a result of cash flow requirements. In other words, after projecting cash flow from operations minus cash needed for working capital and fixed capital (PP&E), an analyst can determine financing needs. It is then a modeling choice regarding the extent to which incremental financing is obtained from debt or equity. An analyst can use information from historical and targeted leverage ratios in making that choice. Now, the reason that cash flow is listed here with no reference to ratios is that cash flow is often one of the most important outputs. So, if it's not the most important output of models, particularly valuation models. The level of operating cash may be an input to forecasts, but change in cash is an output in itself. Now, as noted, cash flow, i.e., the change in cash, can be an interim output in the case of models that incorporate iterations because the amount of borrowing is determined by the amount of cash flow before incremental borrowing. One common solution for that iterations or the circularity problem that we face in our forecast uh, is to forecast interest expense based on the balance of borrowings at the beginning of the period. This solution is generally acceptable in situations where decisions are not overly sensitive to the exact level of interest payments in each period. And with this, we end our coverage for Chapter 7 and our um, uh, financial statement analysis course. In this one, we looked at financial analysis tools, including graphics, which facilitate comparisons and regressions, quantifying statistical relationships. We looked at common size analysis, expressing financial data, including entire financial statements in relation to a single financial statement item or base, just like we've done for chapters 4 and 5. And then we moved on to look at ratios, which express one number in relation to another. And this facilitates comparisons, trends, and cross sectional. And we, in that ratio category, looked at 5 different categories of ratios, including the activity, liquidity, solvency, profitability, and then we ended with valuation ratios. I hope you guys enjoyed today's lecture, and I hope you found it useful and informative, and I would be happy to answer any of your questions that you may have. Thank you all for listening, and I hope you guys have a wonderful day.